We're living through an incredibly challenging period. Inflation is higher than most people, savers, consumers, and investors have ever experienced before. For the last 4 decades, inflation hovered around 2 to 3%, and yet in the last few months, inflation has spiked to nearly 9%. This inflation has been broad-based, spread across the economy. Food prices are up over 10%. Energy is up over 34%. Airline fares are up over 37%. Used cars and truck prices are up over 16%. This inflation is almost as bad as the 1970s when it ranged from 6% to 14%. While the cost of real goods and services keep going up, financial assets like stocks and bonds keep going down. The Nasdaq is down over 20% from its 2021 high. Many growth investors are down over 70%. Old retirees and conservative income investors are losing out as inflation is outpacing their dividend returns, and their bond portfolios are also declining. So far in 2022, a portfolio of long-dated U.S. Treasuries, which is supposed to be one of the safest securities in the world, is down over 20%. Is there anywhere safe to invest? How can you protect yourself from inflation? When I have tough investment questions, I like to ask myself, what would Warren Buffett do? After all, he's seen almost everything. Buffett started investing in 1942 at 11 years old. At the time, the U.S. was losing the war in the Pacific. Thankfully, the U.S. and its allies won World War II, and Buffett has consistently owned stocks ever since then. During Buffett's lifetime, he has seen inflation, deflation, bubbles, and busts, and through it all, he's gained immense wealth. By my estimates, had he not gifted any of his Berkshire shares, his net worth would be in excess of $200 billion. So how did Buffett perform during the last time the U.S. had high inflation? While high inflation in the U.S. peaked in 1980, the 1970s are well remembered for spiraling costs and energy shocks. There was not one, but 2 energy shocks. The oil embargo of 1973 caused oil prices to rise nearly 300%. There was a devastating stock market crash from 1973 to 1974. And yet, it was during the 1970s, a period of high inflation, that Buffett generated some of his best return. Warren Buffett took control of Berkshire Hathaway, a struggling textile manufacturer, in 1965, and by 1979 he had increased its value by nearly 2,500%. This was more than 18 times better than the S&P 500 during the same period. So how did Warren Buffett crush the stagflation of the 1970s? During the 1970s, Buffett made dozens of investments. To name just a few, he bought Geico, Washington Post, See's Candies, Blue Chip Stamps, and advertising agencies like Interpublic Group and Ogilvy and Mather. In some cases, he took small bites out of large public companies, and in other cases, he gobbled up the whole business. While there were dozens of different investments, there are some big lessons investors can learn from Buffett during this period. The first lesson is that you need to focus on growth. This may come as a surprise to many investors familiar with Buffett's deep value persona. After all, he eats McDonald's for breakfast almost every day, and he also lets the daily stock market prices decide what he gets to eat, whether it's a sausage McMuffin or if he can splurge for a bacon, egg, and cheese biscuit. So while he's clearly focused on value, the reality is that Buffett is also very focused on the future growth of his investments. In the 1970s, he saw that his legacy Berkshire Hathaway textile mills were struggling. Here's how Charlie Munger, Buffett's business partner, assessed the situation.
You can't imagine a more lousy business than New England textile mills because textile is a congealed electricity, and the electricity rates in New England were about 60% higher than TVA rates. So it was absolute, inevitable, certain liquidation.
In other words, these textile mills, where Berkshire Hathaway gets its name, operated at a competitive disadvantage as their energy costs in New England were much higher than competitors in the South, so it was only a matter of time before they went out of business. So what did Buffett do? He reinvested the proceeds into better, faster growing businesses. In the late 1960s, he bought a bank called Illinois National Bank and Trust, and he also bought National Indemnity, a special insurance company. In the 2004 Berkshire Hathaway annual report, Buffett wrote, "Indeed, had we not made this acquisition," speaking of National Indemnity Company, "Berkshire would be lucky to be worth half of what it is today." National Indemnity cost Berkshire less than $9 million, and yet it has since created tens of billions of dollars in value. What's the lesson? Focus on growth. If you find yourself holding a company with limited or terminal growth prospects, it's time to refocus on growth. This is particularly relevant when there's high inflation. If there's a 4 to 8% annual inflation going forward, your companies need to be growing even faster just to stay in place. One example of a company that I personally own at the time of this video publication that might fit this profile is Alphabet or Google stock. They have a lucrative search business, but they've consistently reinvested into other fast-growing enterprises like YouTube, Google Cloud, and artificial intelligence. For more compelling stock ideas, check out unrivaledinvesting.com. What's the second lesson? The second lesson is to be opportunistic. Let me elaborate. Investing is simple, but not easy. What do I mean? By simple, I mean that finding great companies is fairly straightforward. Your investing checklist should include companies with 1. Strong growth prospects, 2. Significant free cash flow, 3. Solid competitive advantages, and 4. Shareholder-friendly management. That's most of what you need. The challenge, however, is that it's not always easy to pay the right price. For example, during the 1960s and early 1970s, investors loved to focus on great growth companies that you could buy and forget about. They were called the Nifty 50, and they included investor favorites like McDonald's, Polaroid, Sears, Avon Products, and Eastman Kodak. They were also some of the worst performers during the 1974 stock market crash and the rest of the decade. So what happened in 1974, and why did the stock market crash? Actually, several things that might sound familiar to investors today. First, inflation jumped higher in 1973 and 1974 to 12%. Then the Federal Reserve tightened interest rates to 13% to return price stability and cool off the economy. The US economy quickly contracted over 2%. As the economy declined, so did many stocks. Berkshire stock plummeted nearly 50% in 1974. Many stocks in the Nifty 50 collapsed. Over 2 years, Polaroid fell 85%, Disney fell 81%, Xerox fell 65%, and McDonald's fell 61%. These were once the favorite growth stocks on Wall Street, and their valuations collapsed with higher interest rates and the 1974 recession. So what did Buffett do during this time? He was buying aggressively. Great companies were trading at dirt cheap valuations. One such business was the Washington Post, which had declined nearly 40%. At the time, Washington Post was trading at 12 to 13 times earnings and had a history of growing around 10% a year. In the decade ahead, they grew earnings per share by 10 times and was a fantastic investment for Berkshire. In 1974, Forbes magazine reported that Buffett was seeing so many bargains he felt like an oversexed guy in a harem. The investments during this period and their subsequent gains led to Berkshire's fantastic outperformance in the following years. In both 1976 and 1979, Berkshire Hathaway stock increased by more than 100%. The majority of Berkshire's 2,500% returns from 1965 through 1979 came from the period after the 1974 crash. The bargains from 1974 were life-changing for Berkshire Hathaway. So here's the key takeaway for you. We will continue to have economic cycles. There will be booms and busts. When inflation is high, there's a good chance you might get incredible bargains in the future as the central bank is forced to raise rates and weaken the economy. Sentiment will continue to swing from overly greedy to overly fearful. Don't just buy great companies regardless of valuation. Wait. When there are bargains, and inevitably there are periods when stocks sell off, be opportunistic. Like Berkshire, opportunistic investing can lead to life-changing investments. Before jumping to the third and most critical lesson, hit that like and subscribe button if you're enjoying this video on Buffett's lessons from crushing stagflation. This third and last lesson was particularly surprising for me when I first learned about it years ago, and it might be the same for you now. Let's hear what Buffett had to say from his 1979 annual letter. One friendly but sharp-eyed commentator on Berkshire has pointed out that our book value at the end of 1964 would have bought about 1/2 ounce of gold, and 15 years later, after we have plowed back all earnings along with much blood, sweat, and tears, the book value produced will buy about the same 1/2 ounce. A similar comparison could be drawn with Middle Eastern oil. The rub has been the government has been exceptionally able in printing money and creating promises, but is unable to print gold or create oil. We intend to continue to do as well as we can in managing the internal affairs of the business, but you should understand that external conditions affecting the stability of currency may very well be the most important factor in determining whether there are any real rewards from your investment in Berkshire Hathaway. What's this mean? Despite having one of the best investment track records from 1965 through 1979, a period where Buffett's Berkshire Hathaway dramatically outperformed the S&P 500 by 18 times, Berkshire's performance was only in line with the price of gold and oil. This also means that most index investors dramatically underperformed commodities. This is really important. From 1965 through 1979, or 15 years, investors in the S&P 500 lost real purchasing power as inflation outperformed the index. What? Holy moly! This is clearly not always the case. But when there's a lot of money printing and inflation, commodities can dramatically outperform stocks. The Federal Reserve can always create more money, but it can't print more oil. Perhaps Buffett also learned a lesson from this period, and this is why his largest recent bet, roughly $40 billion, has been on oil stocks. This is why it's so important to keep an open mind during periods of high inflation. A lot of investors are focused on averaging into the index over time, but are you willing to stick through potentially 15 years of declining purchasing power where you might have been better off keeping an open mind and looking at what was working? In today's environment, that's mostly energy stocks. So will commodity investments like oil stocks outperform the S&P 500 over the next 5 to 10 years? The answer depends on leadership. Is Jerome Powell, the chairman of the Federal Reserve, serious about cracking inflation? What if unemployment starts going up, but oil prices remain high or go higher because of supply limitations which remain unaddressed? Will Powell continue to raise rates to crush inflation? Can the U.S. government even afford higher interest rates? The U.S. is now more indebted than it's ever been. The U.S. already has a $1 trillion deficit. Won't higher interest rates only make U.S. borrowing needs even worse? With public debt to GDP north of 120%, with every 1% hike in interest rates, it'll shave off at least 1% from the economy over time. How severe of a downturn will Powell risk? In summary, stocks aren't always the best investments, and a lot depends on the decisions of the leadership in power. If inflation persists at 4 to 6% in the years ahead, it could be better to own commodities than the S&P 500. I discuss more about oil and the investments I'm considering at unrivaledinvesting.com. So the summary lessons from Buffett crushing the 1970 stagflation are: number 1, focus on growth. If your stock is cheap but can't outgrow inflation, should you refocus elsewhere, similar to how Buffett expanded from textiles? Number 2, be opportunistic. Great companies aren't always cheap, and waiting for bargains can lead to life-changing opportunities, similar to how some of Berkshire's best returns came after the 1974 stock market crash. Keep in mind, the 1974 crash, like today, was caused by higher inflation and higher interest rates. Number 3, keep an open mind. While stocks are commonly perceived as the best asset to own always, that's not always the case. Depending on the leadership of Jerome Powell and the Federal Reserve, commodities might be a safer bet to preserve your purchasing power. What do you think? Will the S&P 500 underperform commodities in the decade ahead? If you enjoyed this video, please make a point of hitting that like and subscribe button. Thank you for watching.